what we're asking now is where are equities headed next? Let's ask our next guest, Michael Dix, Head of Economic Research for Barclays Wealth. Hi, Michael. Thanks very much for joining us. Equities seem to be your favourite asset class right now. Why is that?
Well, I think two things really is top down, if you like. Global economy is doing reasonably well. US in particular, growing pretty reasonably and expected to continue. And then if you like, the bottom up side of that is the corporate sector is also doing pretty well. So we're seeing that with earnings reports, if you like, margins coming back, profits coming back. And that's probably going to persist some time. So
how much of your thesis, your forward-looking scenario, is based on interest rates staying low in the likes of the US, in the likes of the Eurozone and in other economies?
Well, that's a strong presumption. And I think, we're looking at inflation, generally speaking, heading south in core measures. And I think in particular, if you take the US, say that that Cleveland core measure under 1%, nothing on the radar screen to suggest that they want to raise rates. More tricky in some places, like here in the UK, but a presumption that we're going to sit with rates more or less where they are all year. Talk about putting rates up, but not much action.
Is deflation a risk, Michael, or not? In the US, especially?
No, I think in Japan for sure, and that's going to persist all this year. If you think about the US, there's a small risk. I think that we get some negative readings. If you look in the labour market in particular, compensation per employee down at 1.5%, that's an incredibly low number. And obviously the unemployment rate still stuck close to 10. So that is a risk that wages keep drifting down and you get a short burst of negative inflation. But I wouldn't call it deflation in that sense of it being rooted.
Your central scenario states that there'll be a sluggish global recovery, but what are the risks even to that scenario?
Well, I think in a sense what we've seen in Greece happening elsewhere, that's the main concern we have. Public finances more or less everywhere in a complete mess. Governments saying we need to promote growth, keep recoveries going or get them going in the case of somewhere like the UK. The concern is that markets saying, hang on a second, that isn't sustainable, you're going to have to tighten up sooner. And if you take the example of Greece, that tightening is going to put them into a deep hole, a deep recession, probably for several years. So the real risk is we get already people sniffing in the US that the deficit's too big. Obama obviously is thinking about next year before you even touch the brakes on tightening, and loosening is order of the day at the moment to improve that labour market. It may be that markets force the pace and the risks, if you like, get out of control. What
about the UK? One day into the election campaign, what's your outlook for the UK economy, depending on the various scenarios of who wins this election?
Well, I suspect that actually whoever wins, hung parliament or a victory for either of the major parties, and you'll probably get more fiscal tightening than is in the official budget at the moment. So that would be a good outcome. But I think you'd probably get there quicker if you had, say, a Conservative victory. And you'd probably see the currency rise a bit, which would, both those things, make it easier for the bank to be sitting on the sidelines, not just this year, but perhaps a lot of next year in terms of rates.
As you can see there, our guests, our viewers can see that news conference about to kick off. We're going to go to it in a second. Not quite yet. Michael's going to stay with us to chat in the meantime. Fixed income, Michael, is it a no-brainer? Avoid it because governments are just going to have to keep issuing more debt to get themselves out of trouble?
Well, that side of the argument's a no-brainer. But, and I think, really important but, we also know that fixed income gets driven by that inflation trend, which is downward and supportive of it. But it's also pretty good insurance if we were to get, the risks materialise and you go into a recession. So I actually think, we're umming and ahhing, we're staying on the sidelines rather than, say, get short on the presumption that the central scenario plays out and yields go up. And you even get negative returns in a lot of fixed income areas. Preferring, in a sense, to have a bit of insurance against those risks materialising. So we're staying neutral, saying in that situation, they would do very well and no other asset class would.
But corporate balance sheets are in better health, so are they more attractive to us, corporate bonds, right now?
Yes, especially I think the high yield, end of the spectrum, if you like, that's closer to equities in the way it tends to perform. For the next quarter or so, I'd say, yes, stay long those. If you're, again, looking further out, don't expect to enjoy the ride for long. Get off the wagon, by the middle of the year, say.
Michael, thanks very much for joining us.